welcome aboard. I'm Will Walker, VP of Business Development at CrowdCreate, and this is going to be our first kickoff for our invitation-only mastermind webinar series. And the first series is going to be, first theme is going to be talking with some very successful, informative, insightful leaders in real estate and thought leaders. And it'll be a proven key top leaders that are in different industries and different phases of real estate. So I think you'll find it very interesting, free-flowing, insightful, and moving along pretty quickly. This is our first real estate virtual event and lunch event, I should say. So don't forget when you finish your virtual lunch to save room for your virtual dessert. My wife put in that joke, so I'll just let it lay there. Anyway, I'm not taking credit for that. We have a great lineup of speakers, accomplished speakers, and successful entrepreneurs, investors in real estate. And our, topic of discussion is really going to be what are the biggest opportunities that you see right now, they see in real estate because of the crisis, and how are you positioning yourself, your company, and your projects in the next 12 months? And where do you look for the profit centers? I mean, we're all interested in making money and getting better and collaborating, especially at this high level of participation. So ideas, trends, thoughts, insights, and collaboration is what we're trying to encourage here in this growing CrowdCreate community that we're launching with this first webinar. So that's great. And they're going to show a lot of different capital sources, insights, opportunities, blah, blah, blah. Let me introduce you. I'm going to go right into our first speaker here for time, because they're all timed to about 10 or 11 minutes. So we want to take advantage of what they've got to say and work with us on. So our first speaker is David Finkel. And David is CEO of Maui Mastermind, but he's also a very successful real estate investor who's had tremendous personal success in investing, and he advises some of the best and brightest real estate entrepreneurs, developers, other people in the country as far as how to position themselves, how to take advantage of the current and future market conditions. So without further ado, I'm going to bring on David Finkel. And David, welcome. Thank you for your time today. Love to hear
I appreciate that, Will.
Hear your thoughts.
Yeah, absolutely. So I think if we're going to talk about opportunities, I'm going to come at it two different ways. I'll come at it first for what I would be talking if someone here were a client of mine, here's what I would be looking at, what I'm personally looking at. Then I'm going to come from the perspective of, if you're building your company, some of the things that you're going to need to do currently right now with the shift to more virtual. So I'll give a quick story that'll give a perfect example of what I would tell someone for opportunities and how I look at it. So I was talking with a guy by the name of Mark, who was a coaching client of ours who runs a commercial real estate firm. They do a lot of different things. They run single tenant properties, commercial properties that run gyms that they have a chain of. They also lease out space. And right now, for the last several years, they've been getting into self-storage. And so one of the things we were talking about for him, I think the big point I would share here is I'm less concerned or enamored of a niche, and I'm much more aware for me of where do I actually have my advantages? Where am I actually really, really good at? So Mark is really good at the development of new projects, the construction side, et cetera. So for him, it's finding really good plots for him to be building self-storage facilities on. That for him is where his advantages are. And so we had this conversation about, look, I mean, over the course of the latter half of this year and into 2021, there's going to be a lot of opportunity. And we saw this going on in, after the aftermath in late 2009 into 2010 and 11, when you could get financing again, about the buying opportunities and different niches. For me, the niches I've always looked at were office space. That was one that for me, I think I've got advantages of knowing what great deals are and what they look like. So I gave him two pieces of advice. Number one was I suggested he hire a researcher to put together a target database of 400, 600 different parcel owners that were areas that he wanted to be building self-storage in for him to do. And start making sure that each quarter he's doing some kind of touch with these owners, a letter, phone call. Staff members can help with this part as well. Emails can go out with that. Again, it's cheap for the research side. You can hire a VA overseas to pull a lot of that info, get onto Upworks and hire someone who can do the research on public records to pull the database together on a spreadsheet. Second one was the broker side. I suggested to him we find the 50 to 60 brokers that are in the cities and areas that he is interested in doing. He actually does this in the South in the United States. So for him, Arkansas and some areas in the outlying states right nearby touched to that where he's focusing on. I said, well, great. Who are the 50, 60 brokers who really are the movers and shakers there? And are you touching them every quarter with your deal criteria? Which is my last piece of advice on that part, which is I found for me, when I've made my best choices or my worst choices have to do with, do I really have a clearly defined in writing deal criteria that I'm looking for? I'm not going to be the person that's going to go into self-storage. Why? I don't have the expertise in that. I don't have the experience or the track record. Office buildings I know really well. Apartment complexes I know really well. I know what a great deal is. And so by doing these two simple things, by building these databases, I'm going to find a lot of off-market opportunities. And I think that's probably the biggest opportunity for people right now. How am I systematically going about putting my feelers out to the right places to find those off-market opportunities in niches that I understand, so that when I go to underwrite the deal, I know it's a great deal. So that would just be one comment, Will. I think I would also share two quick ideas for the business side. So it's not just enough to do our investing. We've got to build our investment company so that we're doing smart things. So one thing I always talk with any coaching client about is we call it your limiting factor. What's the one ingredient in your business, whether it's an investment company or if you have secondary businesses like I do? What is the single biggest constraint to growth? Is it incoming leads coming in? Is it sales capacity? Is it underwriting capacity? Is it funding? And when I identify as narrowly as possible my single biggest constraint to growth, I ask the question, how do I push that constraint to growth back? And we use a technique, we call it the sweet spot analysis, something I've written about in a lot of the different books that we've done. But it's a simple matter. I brainstorm 10 or 20 different solutions to push back that limiting factor, and I put them through two filters. The first filter is we call it a low-hanging fruit. I go through each idea on the list and say, is this a low-hanging fruit? Easy to do, high likelihood of working. If it is, I mark it off.
Okay.
We're not hearing David.
David, we're not.
David?
As an ask, is this a home run? Yep, I'm sorry, I must have been a bandwidth piece there. So on the home run side, I'm looking for something that's going to move the needle big. And those things that are both low-hanging fruit and home runs out of my list of 10 or 15 or 20 ideas, that's where I want to put my energy and effort in. That sweet spot analysis is so critical. And then two quick ideas. A lot of you are having to have your staff work remotely now. We're used to having it in an office. Physical distancing is a big deal. So having run for the last 25 years, all my companies virtually, where I've had staff across the US and North America, two quick ideas that'll help you there. Number one, we have to shrink the units of accountability. If I've got staff that are no longer remote with me, it's not enough for me to have monthly or quarterly accountability. At a minimum, I have to have the unit of accountability be weekly, and in many cases even daily, which brings me to the second comment, the biggest point failure. And I see this all the time with our coaching clients that have made the shift from having physical spaces where they could get away with some bad habits with how they ran their staff to having their employees be primarily virtual. They haven't really done a great job of defining what the role is for these different people. What I mean specifically is they've got a job description. Joe is responsible for X and Y tasks and responsibilities, but what they don't have is a really clear measurement of what does success look like for Joe in that role, quantitatively and qualitatively, in writing on the job description, with one more thing. How is that actually being measured? And when I can give my people, here are the KPIs that are most important for you, or here are the qualitative measurements that if we see these things, you're being successful here, it makes managing my remote staff much easier. So those are just some quick and dirties that I hope are useful, Will. You are on mute just to let you know. And we will.
Real quick, or real last comment on there, what is your outlook for timelines for coming out of this or whatever? What's your thoughts there? Just briefly, if you would, because we're right at the 10-minute mark.
Sure. Yeah, I mean, my sense is this is going to take longer than we really think with that part. However, we're going to get, this is the beauty of it. And if there is a good thing that comes out of it opportunistically, it's going to take longer. And what happens is people have a really poor memory. Right now, people are thinking it's going to get over quicker. And I think what's going to happen is as it takes longer, there's going to be more despondency, more opportunity. But here's the other part. Generally with the real estate, what I see is there's anywhere from 12 to 24 months of a tail end where the market is actually increasing when people still have this cultural blind spot where they think it's as bad as it was before when it's no longer. I saw that in 2011 and 12 from what happened in 2009 and into 2010. You saw that in 2002 into 2003 and 4. People were, the sky is falling, the market was strongly climbing with those parts. So that to me is what I see as the real opportunity in the areas that you know best. This would not be a time that I would be going to pick a new niche. I would stay with niches that I understand so that I can underwrite great deals.
That's great. Thank you, David. Excellent. Well, that's words of wisdom. So we sure appreciate your time and your opportunity, your books, all your programs speak for themselves over many years for success. So thanks for that. Okay, we're going to move right on over here to Zachary Street, but I think you'll let me call him Zach, hopefully. And Zach is, for those of you that don't know, he's with George Smith Partners, and he's closed in excess of $1 billion and underwritten in excess of $6 billion of debt and equity financing for all kinds of things in real estate. So talk about somebody diversified who's seen it all and can certainly plug in a lot of fingers in different dikes. That's Zach Street. So Zach, I'm going to go ahead and let you take it away. And
thanks, Will. Appreciate you putting this together and appreciate you having me, and definitely a tough act to follow in what David said. I thought maybe I'd approach this and talk about maybe 3 broad opportunities that I see today. I think, one is very general. One is leadership and enhanced communication. The second is I'll talk about opportunities and deals today. And then I think the third is I'll talk about opportunities that we see down the road, maybe 3 to 9 months from now. But I think maybe the biggest opportunity in front of us is really for leadership and enhanced communication. And I think this occurs within multiple spheres. I think there's an incredible opportunity for leadership within organizations, not just real estate. Leaders, whether they be at the top or mid-level managers or people just starting, really have an opportunity to rise to the top here, to set tones within their organizations for how you work during a challenging period of time. I think people's true colors, no matter where they are in the business industry, tend to come out now. And you've seen amazing things occur. You've seen work from home occur. You've seen safety and security of organizations occur. You've seen Zooms occur. You've seen a lot of changes. And I think a lot of that is about leadership. And I think it's about enhanced communication. With respect to real estate, we are seeing more communication than ever before within our industry between sponsors and tenants, between sponsors and capital sources, and heck, even between advisors. I think that over the last 6 weeks, myself and the partner that I work with at George Smith, Malcolm Davies, have had hundreds of conversations, if not over 1,000 at this point, between the two of us, between us and our clients, us and capital sources, to really understand, what are our clients' needs today, and what capital sources are available to service those needs today. And maybe more importantly, since we are in a challenging and opaque market right now, what are the opportunities tomorrow? And I think that, we always talk to a lot of folks. It's the nature of our job. And it's incredible that the pace of that really hasn't changed due to COVID. And, that's thanks to technology. And I guess, it's just sort of how we're wired. So I thought that was an interesting kind of big picture opportunity today, for folks that are wondering, well, what should I do? Talk to people, figure out what they're doing, figure out why they're doing it or not doing it, and when they're going to start doing it. So with that, maybe I'll quickly segue into, deals today, and then what I think are the opportunities down the road. Look, we're in a crisis. There's no question about that. People know about the unemployment figures. They also know about all the positives, the stimulus. I think There have been more loans done by the SBA in 14 days than there were in 14 years, even exhausting the first 350 billion of PPP. So that's huge. There are also lenders that are still lending today. I would say it's probably 15 to 20% of pre-COVID lenders, but they're still active. On the multifamily side, you obviously hear a lot about Fannie and Freddie being active. I think is great. On the bank side, both regional and money center banks, there is some activity. It is more conservative than it was before, and then unlevered funds, there is some activity. On the whole, yes, leverage is down a little bit, and yes, pricing is up somewhat too. But if deals that need to get done today, are out there and we're working on them, whether they're purchases that can't be delayed or refinances that need to take place today, there is capital available for those deals. We haven't ground to a complete halt. Yes, we're operating at reduced capacity for sure, but there's still stuff getting done today. We closed the deal yesterday. It was a specialty industrial deal where actually Abbott Labs was the tenant. So that was, a good deal to get done in this climate, in this environment. We closed that deal with a blank. It was a floating rate deal. It was an acquisition. It was industrial, and the pricing on it was pretty fantastic. I would say it was pre-COVID type pricing. So deals are still getting done, and there's still capital out there available to do deals. We are working on a couple land financings right now. One, we're actually getting very close to term sheets being signed, which is really interesting. The land is still financeable today. And we're starting to work on a couple multifamily bridge deals as well, coming off of construction loans. And we think there's capital available for those types of deals today. So we're excited about that. In deference to time, I could talk much more about the deals that we're doing. Maybe I should also talk about the opportunities down the road. So no question, there's going to be a lot of fallout from COVID. And in the hundreds of conversations we've been having with equity sources, their two focuses today are as follows. One, obviously asset management and putting out fires in their current portfolio. But two, every single one, and most debt providers too now, are starting to talk about the distress opportunities that are going to emerge from this crisis. The thinking is that we're starting to see some cracks today. You hear about some distress note purchases. You hear about some margin calls that are occurring, for the debt funds and mortgage REITs and some of the CLO lenders that are out there. You're starting to hear about things trade, not en masse, a little bit. You're hearing about tapes of residential assets being reviewed by hard money lenders for acquisition too. The thinking is that, down the road, there's going to be a lot more distress that hits the marketplace, just in the form of assets that need to be recapitalized through rescue capital. That's a big focus in the equity world today. How can I structure maybe, preferred equity into deals that wedges between an existing senior loan and equity to provide negative OPEX, negative carry for 2 or 3 years for assets maybe in a hospitality and retail space, and sometimes maybe even multifamily and office that are going to have that need as a result of this. That's a big focus of conversation. Acquiring, assets that have been repriced from COVID, whether on or off market, has become another big focus. And certainly a third is note acquisitions, note financings. All of that is out there. And that generally, when you look at crashes historically, the Great recession of 10 years ago, it was the same. The opportunities occurred first in the securities market with, CMBS freezing, and then existing bonds being able to be bought at a big discount. And then TALF came in, and slowly the market reemerged. And then you ended up seeing, a lot of distress that was in the private market space. So I think you're going to see that. I think it's going to vary by geography. I think it's going to vary by asset class. But it seems like in every conversation that we're having with equity and debt sources, it's really focused on that. It's focused on a post-COVID world. It's focused on, how do we reprice and re-understand values, occupancies, rents, and where assets should trade. So I think I've probably exhausted my time. I'm happy to take any follow-ups. That's maybe a big picture opportunity as we see it.
Still got 2 minutes left, and I know you and I've had some personal conversations about the debt and how things are going to look and how to position and take advantage of yourself. So I appreciate you covering that. Any other thoughts or any other trends that you see either in that line of thinking or other experiences that you've had?
Interesting trends that we see. I think the biggest one is what I mentioned, really, that like you've seen some distress in the public market, and there's usually a 3 to 6 month lag for it to sort of filter into the private market. And we haven't seen, a ton of it yet. We've had anecdotal conversations. I was talking to a sponsor yesterday to give you a market data point. He bid on a portfolio of 4 hotel assets that a REIT was selling quietly because they were considered, not strategic assets for the REIT. And I asked him, well, what discount to pre-COVID values did you bid? He said 30%. And I said, you'll win it. He said, no, I think there are guys that will win it at 20%. So I'll effectively be outbid. So I thought that was pretty interesting. We heard about a multi-asset that was for sale in Vegas for 30 million. That's actually being picked up for 24 million. So I think you are very slowly starting to see the beginning of a repricing occur at the asset level, but I think it's going to take time. And maybe I'd end where I started on a small tangent, but my brother-in-law to be, sister-in-law's fiance, works for in the tech industry for a very big company that we'd all know. And he said that company has actually doubled down on advertising during this crisis period. And their view of it is, look, fortunately we have the cash and we can do it. We want to make sure that people don't forget about us during this time, and that we're poised to capitalize on any opportunities that come down the road. So I think another opportunity for folks listening is, it's about leadership. It's about enhanced communication. It's about making sure that folks know that you're out there for them, even when times are really rough. And when they might be rough for the next 3, 6, 9 months before we come out of this, that you're still there. And certainly that's a principle that, I think we at GSP and myself and Malcolm have really tried to take to heart here, to just let folks know, hey, we're here. We're happy to be a resource. Let us know how we can help.
That's great. Thank you, Zach. That's all good, really useful information. So we're going to move right on over to the famous and infamous Rob Seacrest. And Rob is president of the Polaris Group and a very successful real estate cannabis debt fund. We've had the pleasure of working with Rob at Crowd Create, all of us at Crowd Create, and get to know him and his partners. But Rob comes from also a hard money lending and real estate background. He and his partners are very experienced. So we could do a whole segment with Rob on different aspects of profiling and investors and all the things he's doing. But Rob, why don't you take it away and take it where you want to go?
Sure. Well, thanks, Bill, for the nice introduction. And it's a pleasure to be amongst all these very intelligent speakers that we have here today. And some of them we already have known for quite some time from our previous non-cannabis experience. So we come about it from a different perspective. We had been in the non-cannabis lending for many, many, many years, and we had pivoted and left that sector back in 2016. So we've been originating specialty use properties with cannabis tenants since that time, and we've now originated more than 33 transactions for 70 million bucks, and still have today about 22 of those going and servicing about 55 million. And just to show some perspective, all of our borrowers are continuing to make their payments, and they're having some of their best months ever because cannabis was deemed a non-essential business. So we had kind of felt a couple of years ago that we were getting to the top of the market, at least from a risk perspective, meaning that the yields were so low at 6 to 8% to our investors, and the LTVs were so high, it just didn't matter. It wasn't worth it to our investors to go in that sector. So we had pivoted a while and we launched our fund. So we had already kind of transitioned out of this sector and had prepared for this, what we had prognosticated at the time would be able to better sustain a real estate down cycle or even economic downturn. But this is different. This is a total economic stop. And so far, we're still sustaining it okay. And we'll see if that continues through as the months go on. But apparently people are still buying medical and recreational cannabis at this time. But I suspect that could change if nobody has any money at all. You know, that's effectively some discretionary income, but I think we'll fare better than most. Some of the things that we're preparing for, as velocity of capital has slowed down for us as well, where our investors and family offices are trying to, one, they had to assess their own operations and get their own housekeeping in line to see how they can work remotely. But not only that, but the liquidity needs are changing, and they don't know what those liquidity needs are. So our velocity of raising capital probably slowed down for new investors by about 90%. With existing investors, it's down about 50%. And we do raise most of our money from our existing investors. So we are prepared to have a cannabis equity fund ready to go. But again, it's a real estate focused fund. And the purpose of that, we already do distressed transactions. That's our niche, and we've always done that, where we're the lender in that aspect. We try not to own properties and have to operate or manage those properties, because it becomes a lot more cumbersome to manage all those different projects. But we have the capacity and infrastructure to do that. So we have a $25 million fund ready to go if we feel that that opportunity presents itself, but we would rather be the lender to that and provide the debt solutions and let somebody else operate that project. But because we're at the tip of the spear of all these projects, some of these opportunities are just too good for us to pass up. And we can't be the lender and the equity provider on the, at the same time. So we'll consider that as we go down that road. But right now we're not doing it. It doesn't look like we see anything yet that warrants that. Some of the things that we learned from the last downturn, the Great Recession, and some other previous down cycles were we had, as many companies do, a large fixed expenses. And when we built this company in 2010, we tried to set it up with the business, corp to corp model, with consultants and third parties for everything that we could that were for professional services, and get away from the employee and benefit model so that we could minimize and scale employees or people that were effectively employees, and pay them a full rate, and they could pay their own insurance and their own taxes and their own stuff like that. So we had already done that model, but the most important about that part of that model is there's certain sectors of our company, fund control services, which takes 30 people to run that department on some weeks, and maybe only 10 people another week. And all that's third party off to one of the largest ones in the nation. And so by being able to be flexible in capacity as those things change, we're not having to lay off any people during this period. And that's a massive lesson that we had learned. And the downside of having those people internally is you have this nut that you have to this monthly nut that you've got to keep paying every month. And it forces some managers to start having to do deals where they may not have wanted to have to do a deal. We can sit and do no deals effectively for a couple of years if we want to do that. We were already decentralized. Our whole model is set up that way, so we lost no efficiency during this. And I think that a lot of newer companies are kind of set that way. But one of the other factors that we learned from the last downturn it's been really applicable during this downturn is that the previous funds that we ran, the investor relations team didn't always pre-qualify the individual investors more than just being an accredited investor. They just made sure that they were threshold. And I like to share that that could bite you in the butt down the road. And so today, I personally approve every single investor and make sure that they are not a threshold accredited investor, that if there was a downturn or a major economic cycle, that they're not needing to come to us for liquidity to help them get through the year or the month or whatever it might be, because that in our previous fund, there was more than 50% that were threshold investors. And they were able to give a vote that made us liquidate assets in a down market. And that was a tough lesson and a tough scenario to see that happen when we felt that those asset prices would come back in 3 to 5 years, which they did. So those are some of the things that we learned. Let me just think if there's anything else. We're just in a different sector, and we're glad that we're in this cannabis sector, which, I think that everybody, I know that Zach's family offices does some stuff too, and some other lenders are touching that, but everybody was really afraid and didn't really understand it. But that has been our niche and our opportunity, that we took our skill set, which is value add lending, and especially broken projects, and just applied that to this new asset class, and we just kind of ran with it. So that's kind of my take on what we're doing and what we see going on.
Yeah, that's great, Rob. Thank you for that. I think also, you know, from my small pulpit perception too, with all the states going through their funding woes and will continue once they get all they need from, or what they're trying to get out of the federal government, so to speak. I think there's going to be a lot of initiatives. Maybe just in the last minute or two we have here, I don't know what you see as far as a trend in relaxing some of the cannabis situations, and also how, if you've changed any of your profiling for investors coming in or for properties that you're evaluating.
So from the state side, there's two ways to go, and most of the states had traditionally done a voter referendum or a vote. And that's now not the trend anymore. Now they're doing it legislatively, where they're just enacting it from the legislative side. So that seems to be happening more and more. From the federal standpoint, what most people don't realize is that I believe it's now like 12% of all banking institutions out there are now cannabis friendly. There's something like 784 depositor relationships out there between credit unions and FDIC insured state banks that are doing both tier 1, which is plant touching, and tier 2/3 ancillary, which was what we are. So the banking has already been worked out from the depositor standpoint, and tier 1 accepts legacy cash as well and does cash transactions. But most people are completely blindsided when I tell them that these banks are also doing lending, both the credit unions and the state chartered banks, and there's even publicly traded banks doing it. So all of these, the banking and the lending is actually already happening. And so I don't see a major shift. Even when cannabis becomes federally deconflicted, it still takes a year or two to write the regs and another year to implement those and negotiating all that stuff. The biggest change that will happen from that will be the emergence of the most efficient capital market in the world, the equity markets coming online, and that will be a major back end of capital coming in to stabilize this market. But it's kind of good that it got all the way here without that, because it's the reverse of what happened in Canada, and it's kind of I think it'll make it a more sustainable industry in the long run. And it was definitely hit in the equity side, you know, prior to this COVID thing. That's
great, Rob. Well, thank you. That's great. Great points, and thanks for participating here. So we're going to move on now to Kevin Maloney, who's a VP at Rivaz Capital, and they're a leader in the Opportunity Zone real estate and Opportunity Zone offerings. Kevin is very experienced, and Kevin, welcome, and love for you to cover some of the topics that we discussed or are discussing here. And just a great guy. They have a great group here in Orange County that we're familiar with at Crowd Create and are working with, very experienced. So we're glad to have you, Kevin, and take it away.
Thanks, Will. Appreciate you having us. Yeah, so we're a real estate private equity firm focused on joint ventures with experienced developers in opportunity zones. For those of you that don't know, opportunity zones were approved under the Tax Cuts Jobs Act of 2017. Sean Parker, first president of Facebook, and Peter Thiel from the Founders Fund got together in 2015 and said, we have a huge concentrated positions in stock portfolios and other companies. We'd like to liquidate those, and we don't want to pay a ton of taxes. And so they created the Economic Innovation Group. That group was able to put a 5-page description together of how the Opportunity Zone policy should work. And that was incredible. That was signed in by the president in 2017. The media doesn't love it because they think it's a tax cut for Trump's rich friends. Trump didn't know much about opportunity zones. He just happened to be the one signing it at the time. But it did have bipartisan support. Cory Booker, Democrat, New Jersey, Senator Tim Scott, Republican, South Carolina, both good people with 50-50 bipartisan support. So that happened over 15, 16, and 17. And the benefit was to investors, if you deployed capital gains into a qualified opportunity zone fund for 10 years, you can avoid paying capital gains on the back end. So you can defer your capital gains for 6 years. You can reduce them by 10%. and you can eliminate completely the growth of the gains deployed into these funds. So there's a lot of nuances. It's very complex. One of the one of the sort of our value add that we bring to the table is the intricate knowledge of the OZ compliance, the policy, the operations, and the deep commercial real estate experience. We've got hundreds of millions that our team has managed for, as proven fiduciaries for large groups around the world, for large funds. And so opportunity zones are very interesting. It's not a sales pitch for those. There's about 8,800 across the country. There are about 870 or 10% in California, and those have been hit. There's no avoiding the coronavirus outbreaks has really taken an unprecedented toll on the global economy. It's disrupting our daily businesses and financial markets. There's not a lot of liquidity out there. The government will continue to print money. Are we going to pop out of this thing in 2 or 3 months? No. Are we going to go into the dark ages for 3 years? No, I don't believe so. I think residential real estate will stay somewhat stable for a while. I think commercial will have some reset. I think multifamily is a decent opportunity to look at where we're focusing. Retail will get crushed, of course. I think 60 to 80% of businesses will be back online in a 6-month time frame. I think a second wave of the virus could prove scary and deadly, but in the 1918 flu, there was 3 waves over a 2-year period, and we knew a lot less back then. We have a lot better ways to communicate. But I can't speak to the severity and the duration of the current situation, but our goal is to really, assemble, a defensive fund comprising assets that will provide long-term value over the 10-year period. So we're dealing with investors that have generated capital gains and can afford to part with those gains for a long time. And that's, a very small part of the population, but they understand that if you can legally avoid or defer, reduce, or eliminate taxes, it's completely illiquid when you write a check to the government, and it's only slightly illiquid when you write a check to these funds out there. There are, I would say, there was an article that came out today in BizNow. There are roughly, about 250 different funds out there, about 210 different opportunity zone funds representing about 45 to 50 billion in committed capital. And so obviously the majority of those are real estate related, and 60% of those are focusing on housing projects, a lot of affordable housing projects. So multifamily housing is interesting to us. We have a thesis that we look carefully at, we're looking at, competitively priced multifamily and some office projects. We just did a medical office facility in San Bernardino County in primary and secondary markets. We like the sports anchored primary and secondary markets where there's good job growth and wage growth over the 10-year period. Now, we're going to have a disruption in that, as you guys know by the news, but we think long-term, the pipeline of pre-identified deals is it's void of any pure play retail or hospitality. And obviously we're going to look at new deals as things are reset. A couple of our projects are on pause. A couple of them we're closing on. A couple of them we will hope to look to get some better pricing. But at the end of the day, our job is to clearly communicate the value proposition, the differentiating, aspects we bring to the table. And now more than ever is really, prudently evaluate our entire due diligence process, our current pipeline, and our underwriting standards are even more stringent today than they were a month ago, as we look at everything through a very conservative lens. The tools we're using to communicate, video, webinars, just like this, what we learned is people want to be connected. They want to feel connected. They want to feel part of a community. They want to be informed, and they want to feel entertained, right? The growth of toy sales and puzzles and games and Netflix and Amazon video sales are through the roof. Clearly, we want to be entertained, but more than ever, we want to be connected and informed. It's difficult when we have a lack of instability in the market, which we do. But when you have lack of clarity also, it really exacerbates sort of the situation. So we're all looking for some stability. and obviously lack of clarity. The government's not going to save everybody. They're going to print capital, of course, print cash. But I think the timeline to come out of this is, probably in the 9 to 18 month range. Back to work in a month, starting to feel some normalcy in 6 months. But the key is really measure 5 times and cut once. I mean, that's what we need to do. Opportunity zones can give you a few hundred extra basis points and upside potential, but we have to remember it doesn't make a crappy deal great. It still has to be decent. So it can make a decent deal slightly more attractive from a tax advantage standpoint. We are working with people that have gains that they have to deploy by July 15th from last year, and there have been extensions for people out there. But from a team perspective, we're working remotely. That's been pretty effective. We are meeting face-to-face 3 times a week. We have our goals that we review with the team. We talk about hurdles, milestones, achievements. We celebrate and recognize people and challenges and figure out how to work together to overcome those challenges. My personal perspective is I'm excited about some of the opportunities out there. I feel bad for the retail folks that are being crushed. Some of those businesses will never come back. And I haven't seen a lot of PPP capital getting deployed by the smaller businesses out there. If you're connected to big balance sheets and you have a great relationship with your current well-known bank, some of those people have been funded in week 1, very few questions asked. I'm hoping the second round are, actually go to the smaller businesses. What is it? 50 to 60% of the American economic engine is derived from small businesses with, 10 to 15 people. I don't know how many of those are actually receiving funds, and those people need to because they are the economic engine. So I'm hoping more of those stories are told on this second tranche of capital that is deployed. But anyways, just checking my notes, it's always hard to follow other good leaders, but yes, communication is key. Right, with your team. I've been busier than ever speaking to our current investors and prospective investors. And yes, many are skittish, sitting on cash on the sidelines, looking for opportunities. But guess what? When the market turns and the deadlines are approaching and people have to deploy capital, we believe that access to information, exposure, and education build credibility and trust. And so the more we can provide access and exposure and education without bloviating, just giving people access to information, I think you build credibility and trust, and you'll end up at the top of the list when people are considering deploying capital into one of these areas that the speakers have discussed today. They're all qualified. They're all excellent vetters on the deals. But, we've been entrusted with a certain amount of capital. We're sitting on a lot of cash. And we have to be good stewards of that capital to drive value for the investors over a long period. So those are some of my quick thoughts. I'm happy to, take any other, questions from you, Will. But it's not business as normal, but, we have to, step carefully and figure out how to, stay connected to these folks and really navigate these uncharted waters. The government's going to help, but it's not going to, we've got to iterate quickly and listen to customers on what they want.
Yeah, excellent. Well, those are great points. And I think you covered every point we're trying to create with this new mastermind community that we're putting together here at Crowd Create, and continuing these discussions, ideas, and sharing future deals and thoughts along with invited only top leaders and thought leaders in this particular space and some other spaces that we'll be covering in our series. So Kevin, thank you. You tagged it as usual, and great that you covered all the connectivity, the trust, the sharing, all of those things. The trends are all what we're trying to achieve here on this webinar series. So
well, thanks for including us. It's just all about information gathering and sharing context as we make really difficult decisions in these current markets. But good level heads will prevail.
Yeah, excellent. Great last thought there. Thank you again. Excellent. So we're going to go to our cleanup hitter here for cleanup batter, and that's Shreyvan Parsi. And Shreyvan has had so much success in in different aspects of real estate. I could read his bio, but it goes on quite a bit, which is normal. He's actually got a book that's just come out as well, The Science of the Deal, but we won't get into that too much here. But he's the CEO and founder of American Ventures, 250 million in planned acquisitions, and they have a tremendous amount of experience, success in different aspects of real estate, including some commercial as well as other aspects. So Trayvon, I'm not going to put any more words in your mouth because I can't do it. So please, let's have you take it away.
Thank you, Will. Thank you all for your time. I think we are living in some transformational times, no doubt. Whether you're affected or not, it's a legitimate inflection point in the industry. So a quick background about American Ventures. We own and operated over 4,100 units in the multifamily space, along with a few other investments within the commercial real estate, including some couple of opportunity zone deals as well. And as a team, we have over 50 years of experience. And I think sometimes that experience counts. Personally, I may have only 15 years of experience in the industry. But we didn't time the market. But in 2018, we made a strategic decision to sell a lot of our assets. We tested first by going into the market, by getting offers on one of our deals in the Dallas-Fort Worth metro. And the offers we received, the 15th offer is even higher than a lot more of any offers that we were thinking underwriting a deal at a 3 to 4 year time point. So we made a decision. If we get our offer at a second and third year deals offer on a fifth year projections, we decide to hit the market, and somehow we decide to sell 3,600 units over the last year and a half. I think we didn't time the market, but I think some of the fundamentals were very clear. People were overpaying. Quite a few unsophisticated investors coming into the market or operators who are in it for fees. I think those are some fundamental things that we saw. The 101 of investment is, do not get into deals when there's no cash flow, but we were able to exit those deals. I think that taught us something, and now we're at a point where 3 to 6 months or 6 to 9 months, these deals will come back into the market at a price that, that we are willing to pay now. We've been underwriting at deals for the last 6 to 12 months, placing offers, but we couldn't win any, or we only won 1 out of the 25 deals we placed offers. So that basically tells us something in the industry. And I think we want to position ourselves to that end. And I think we are basically putting a syndicate of investors for that. But let's talk about the deals which we own now. We own 3 apartment complexes. And I think how we were able to like 90 to 95% of the rents on those properties is by aligning ourselves with the right management. So on March 15th, as most of the counties are talking about shelter in place, we basically decided to have almost daily call on all of our apartment complexes with basically regionals, the CEO of the property management company, and our asset managers. What did we do on March 15th? We proactively reached out to each tenant by having, basically we put a text system in place, which we didn't really have to before, and also emailing all the folks and reaching out in advance. So out of that, 10 to 15% of the tenants reached us back saying that they may see some kind of a hardship. And immediately we put some systems in place where the promise to pay. And for those folks, we did collect, partial payments. And then one of the innovative things we did in all of our properties is on March 15th, we rolled out a email stating that anyone who pays, these are workforce housing communities, just to give you some background, anyone who pays their rent before beginning of the month, basically all those apartment complexes, we basically put certain prices in place, which is a flat screen TV. So somehow on April 1st, we collected 20% more rent on 2 of our workforce housing communities than before. So like that trick worked. And the second one that really worked for us is anyone who is, you're talking about the restaurant industry getting affected. And so we put together a group of employers in those submarkets and proactively reached out to all our tenants stating that if you're out of job, reach out to these employers. And then basically we work with, some manufacturing houses and also some industry, the industrial warehouses in the local community. And by circulating that list, we were able to, and the third and most important thing in this case is the employees that work at our properties are employees of our property management company, even though we support their payroll at the corporate level. So we basically lined up our PPP applications well before most of the banks were accepting. We maintained a very good relationship. I think this is where the regional banks outperform the JP Morgan Chase, the Wells Fargo, or Bank of America's. We have a strategic relationship with Frost Bank, which is more of a regional banker. And believe it or not, we did receive our PPP loans on 2 of our entities already. And I think staying ahead of the game, and I think we were part of the $349 billion, the money that's already went out. So I think the team plays a crucial role. And the most important thing we did at the corporate level, because these are the team players that cannot take any kind of burden. So one of the things we did is 90 days, we decided no layoffs, no matter what. And I think, but as an entrepreneur, the A players survive. And I think 90 days from now, I think there'll be a restructuring in our corporate team where we don't have room for B players. And I think this is the time to hone in and build a solid team. And I think last point I would like to make here is lining up with good debt sources. And I think having access to Fannie and Freddie in the multifamily industry is a very big boon. And I think even though we have not taken advantage of any 90-day optional forbearance that most of the Fannie and Freddie approved lenders are doing, but I think maybe sometimes if it's necessary, take advantage of it, because we can make those payments back in the next 1 year. And I think having that extra cash on our hand by deferring these payments may not be a bad idea. So what we're doing is we're having call with 2 of our Fannie lenders to see what are the implications. Will that be considered a negative remark? If it's not, then I think we're going to swallow the pride and take forbearance if necessary, so that we are flush with more working capital, just in case if this recovery takes longer than 6 months. Other than that, I think I'm happy to answer any questions you may have.
Mm-hmm. Well, that's great. Thank you for that information. What do you anything you want to add in the last minute or so too that we have here for future trends, or any last thoughts, Shravan? Down to about a minute or so, but just appreciate that.
Yeah, thank you. I think one of our thoughts, I think choose your team players because these are the great wealth transfer hands in terms of in times of economic distress. And if you want to be on the forefront of that, choose the right team players, whether it comes to banking, whether it comes to your intermediaries, or whether it comes to your top players, and take care of them now. Because I think I'm personally foregoing my salary and then basically like in the company, and then I'll make sure that I'll be the last one to get paid after 90 days in case we may end up in hitting any kind of hardships. I think this is the time to be stepping up to the table.
Well put. Well, thank you for those thoughts and for the leadership and example that you're putting out for all of us. So thanks again. I just want to close here. A great lineup, great speakers. I know everybody in the audience too has either spoken or could be a speaker. We're going to continue this series starting May 5th with different themes that we'll let you know. Anybody that wants to be added as a panelist or speaker, we'd love to have you included. And then to grow this community too, we appreciate everybody's participation, attendees and panelists that can join us in an invitation only private Slack room community and future webinars in different subjects. So, everybody knows they can reach me, will@crowdcreate.us. For that, we're going to be sending out some different initiatives and ways to join and work with us in the future for future events, that type of thing. I want to thank, I see Sam Hales, who's a leader in the mobile home community division. We have so many good people as attendees as well as the speakers themselves. Can't wait to do some more of these and expand on some other thoughts and insights and trends that'll, I think, hopefully lead us to greater profit and greater clarity and, greater trust. I hate to use that word, but that's the truth. We all know we work and invest with people we like and trust, right? So you got to have that entrepreneurial, you got to have that entertainment factor that Kevin talked about. And you also got to have the right mix of thought leaders like we definitely have here today. So with that, I'm going to go ahead and close. And, once again, we're glad that everybody showed up. Look for our next event on February 5th. That's Tuesday at 2 o'clock, 2 weeks from now. And I appreciate each and every one of you. Can't wait to do it again. Thanks for the information, everyone.
Thanks, Will. Have a good day.
You.
Everybody.
Guys.
Bye-bye.
Hey, Sam, just those that can stick around, Sam, thank you. And I also invited some other people on this call. But yeah, Sam, I'd love to hear what's going on in the mobile home park space. And I read every email you send to me line by line. So
that's great. Sometimes you don't get a lot of feedback, right, when stuff like that goes out. So it's good to know you read them. No, I'd be happy to share a little bit, Jeff.
yeah, please.
Well, yeah, I think first of all, what we were in, couple things, right? One of them is rent collection. Have you followed the data from NMHC? I think as of last week, they were reporting.
I read NHC and then I read your personal email.
Okay. So I think they're reporting across all the multifamily operators that are reporting they're like 93% of March collections, and we'll have another update from them tomorrow. We're at this point across our portfolio of about 2,200 lots we're caught up for March, and that's kind of proving to be, we're seeing, at least anecdotally, because nobody's aggregating the data on the mobile home park operator side, but just in speaking to other people and anecdotally, most operators are seeing the same thing. But of course, that's April, right? So the question is what happens in May and June. I think one thing that's positive for us is the average lot rent is $300 a month. So if somebody gets a stimulus check for $1,200 or $2,400 or even more, that goes a long ways towards paying rent.
Hey, Sam, real quick, since we did have a minute left, I'm glad you did that, Jeff. Maybe you could just tell us about the historical. I was always amazed and, infatuated or whatever with the historical data of mobile home parks and both throughout the years and background. Just briefly, if you would.
Yeah, okay, great, Will. So first of all, Sam Hales, Saratoga Group. We've been in the private equity real estate space for many years. Got into mobile home communities about 3 years ago. The whole reason is, as we looked at kind of other asset classes, and look, we had no idea this was going to happen, right? But knowing that the market cycle, what is a real estate class that ought to do pretty well in a downturn, and that kind of led us to the mobile home communities. To Will's point, part of the research that I did involved looking at, there's actually 3 publicly traded REITs. I had data for 2 of them that are focused almost completely on mobile home communities, Equity Lifestyle, ELS, and then Sun Communities. And what we found is that during the last downturn, in fact, over the last 20 years since they were both publicly listed, so you've got the Great Recession that happened, you've got the dot-com bust, they continue to have same store NOI growth every single quarter. And so, which is kind of mind-boggling that they were able to do that. So anyway, this is a black swan event, pretty unprecedented, and we'll see if that holds true for them as operators through what we're going through right now. But certainly you've got a fixed supply, right? It's very difficult to build new mobile home communities, to get them permitted, and at the same time you've got demand that continues to grow as people look for affordable housing. Something that's interesting, I think, that came out of this is that when you think about alternatives to mobile home communities, a lot of times it's like a B or C class apartment building. And of course, you're sharing common doorways, halls, even ventilation systems. So when you think about things like social distancing and that sort of thing, when you've got a mobile home and it's on its own lot and it doesn't share any walls and it doesn't share HVAC systems, there's people think there may be even more demand for this kind of housing, which I personally, yeah, it's kind of nice to have a business where there's a moat around it and it's really hard to get new inventory on the market, but back away from that, I would love to see communities kind of embrace this sort of development. I think it makes so much sense and would be a real boon for different communities.
Good point, Sam. Thank you for speaking up. We'll definitely have you on the next panel to expand on that more, because I know you have a lot of success experience in single family homes and other developing real estate classes that you segued into in the past before getting into the mobile home community fund and arrangement. Very successful there. So I want to be respectful of everybody's time. We're a few minutes over, but I want to thank again everybody for participating, and we're looking forward to building this community together. So feedback is great. You've got my email. We will definitely reach out and send some information on our future events, as well as the private invitation only chat and Slack room that we're going to be offering. And we're going to continue to grow this with the thought leaders and top investors. Like I say, it'll be very high level, invitational only. So great session, you guys. I want to thank everybody for their participation again, and we'll see you next time.